we all know what went down with SVB, and for me personally, it was a great opportunity to learn a few finance concepts that I somewhat understood, but it was fun to see them play out in real life. So I decided to record this quick presentation, and this presentation is relevant for you if you're interested to know what really happened with SVB. And then you heard a few terms like rising interest rates and how it fluctuates the bond market, or how it affects the bond market, what's the liquidity ratio, what happens when a bank shuts down. And while you want to learn all this, you want to make sure that you're not hearing people's opinions, but actual valid concepts backed by credible resources. And you want to be informed, so you want to know as a layman how it affects you, if you're a business owner or you're a working professional, if it affects you and what you can do should this happen again in future. So let's sort of dive in. The short version, what happened with SVB. SVB, Silicon Valley Bank, a bank with like $250 billion in assets, one of the top 10 banks in US, was taken over by the federal government last week. And they were taken over because they did not have enough liquidity to meet the obligations of depositors. So in short, when depositors came to withdraw their money, they did not have enough liquid, they did not have enough cash to meet these obligations, so the government took over. The good news is, yesterday they announced that, yesterday the FDIC announced that they're going to make all customers whole, which means that all the depositors will get back 100% of the deposit with no loss to them. So the short version is that the crisis was averted. But I learned a few finance concepts. I learned why interest rates and bond prices are interconnected with each other. I understood what's liquidity coverage ratio, and lastly, I understood what's a bank shutdown procedure. What happens when a bank actually goes under? So these are the concepts I learned. So what I want to do is I want to explain the event and the related concept that you can learn from that event. So first and foremost, this happened like last week. So SVB loses around $2 billion in their in bonds, and the long story, the short version is that they sold around $21 billion worth of bonds for a loss of like $1.8 billion. They did this because they wanted to have some money in the bank, so that when depositors are withdrawing money and for like the day-to-day operation, they have some liquid. When they did that, they obviously incurred a loss, and they wanted to cover up for this loss. So how did they want to cover up? By selling equity in the bank. By selling equity in the bank. So they went to a few investors. They said that we are raising $2 billion in return for equity in the bank. And that made me curious as to why the rising interest rates affected their bond price. So I understood that bond prices and interest rates are inversely proportional. So that's the lesson here. Now, I'll try to explain in layman terms what that means. So imagine, for simplicity purposes, mortgage-backed securities was yielding 5% interest rates, let's say, 5 years back. So you put $100 in the bond and you get $5 as interest or yield at the end of the year. So you pay 100, at end of the year it becomes $105. Pretty simple. But let's say, and we've been hearing that feds have been increasing the interest rates, which means that the newer bonds have more yield, have a higher interest rate. So maybe the newer bonds, if you buy them today, will yield 8%, not 5%. So as an investor, you will no longer invest your money in the lower yield 5% bond unless that lower yield bond comes to you at a lower price. So if the lower yield bond is given to you at say $97.5 at a discount of $2.50, and it gives you 105 at the end, the total is still 8%. So it will match the interest rates of the newer bond. So what's happening is actually the price of the bond, which was $100, is now suddenly 97.5 because the newer bonds are yielding more money and giving more interest rates, So the previous bonds lose their value. So that was one concept that I learned as a result of this. Next, this is pretty interesting. These are the exact sequence of events that led to the downfall of SVB. So as soon as they went to the market to raise $2 billion, Peter Thiel became suspicious, and he was like, why are you guys raising $2 billion? This is my understanding of it. But he became curious as to, or suspicious as to, why they're raising $2 billion. And he looked back and saw, they sold those mortgage-backed securities and bonds for a loss of $1.8 billion. So that made him pull his money out of SVB. He was one of the largest customers. His fund, called as the Future Fund, was one of the largest depositors of SVB. He moved all his money outside of SVB. That led that was followed by General Atlantic pulling all their money outside of SVB the same day. And as of Thursday, March 9th, the SVB had $43 billion worth of attempted withdrawals. Now that's a lot of money for a bank with $250 billion in assets. If you try to withdraw $43 billion in a day, that's a whole lot of money. So two interesting learnings for me. One is that the influence and the power of such people is real. A person like this, a person like Peter Thiel, can bring down the entire bank because people follow him, and once the word got out, people started to withdraw all their money from SVB. And on March 9th, on Thursday, they had a negative cash balance of $1 billion, and that's where the FDIC, the government sort of like stepped in and said that, okay, we need to take over. So the lesson here is, liquidity coverage ratio. This is actually a ratio that is required for a bank to operate. And what that means is, so this is another finance concept I learned, which is LCR. What this means is that in any kind of a bank, no matter how many assets you have, you're required to maintain liquidity and cash flows enough to fulfill the next 30 days of withdrawals. Okay, so this is like a stress test for a bank. If you're a bank with like $100 billion and you expect that over the next 30 days around $5 billion of withdrawals are expected, then you need to have $5 billion in liquidity to fulfill these obligations. So that's what an LCR is, right? So on the top, you take your assets like liquidity, assets like high quality liquid assets, divide that by the total net cash flow amount expected over the next 30 days. This has to be more than 100%. You need to have enough money, at least enough money, to fulfill the obligations for the next 30 days. So when $43 billion was withdrawn from SVB in a single day, this obviously went for a toss, and that's where FDIC had to step in. Now the next thing is, what really happens when a bank is shut down, right? So first, what happened with SVB is like, FDIC stepped in. They said that we're going to take it over. And in a typical case, whenever a rundown happens on a bank, or a bank is not able to fulfill its obligation or has to be shut down, this is the typical process. Step one is FDIC will take over all the assets, and they will try to find a private buyer. That's the most ideal situation. So they will go to a bigger bank, and they'll be like, okay, I have a smaller bank with so many customers. You can fulfill the deposits and the obligations, fulfill the obligations of the depositors, make them whole, and you get like all these customers which will become part of your bank. Okay, so they will. That's the option number one, which is the ideal case for everyone involved. If they're unable to do that, then FDIC is going to, and by the way, they usually do the bank shutdown procedures on a Friday. That's the norm. So then over the weekend, they try to find a private buyer. If that doesn't happen on Monday, this is the interesting piece. $250,000, that's the usual norm, is insured in every bank. I was always under the impression that if you're storing the money, thank you. I was always under the impression that if you're storing the money in a US bank, it's safe, right? Like, it's not a bond, it's not mutual funds, it's not stock, it's actually a savings account or a current account. So your money is actually safe. but I was wrong. Your money is not safe. Only $250,000 is safe. And if you're a, if you're holding money in your personal account, 250K might seem like a decent amount, especially if you have like 4 or 5 bank accounts, you've diversified your assets, then 250K is insured per bank. So it seems like a decent amount, but for a company, it's nothing. For a company which has raised like 50, 100, hundreds of millions of dollars, has so much in payroll, 250K is nothing. But that's the amount that is usually insured by the bank. In the case of SVB, out of the $250 billion, on $175 billion, like around 90% was not even insured. That means you can technically you can blow up this money, and 90% of it will not be recovered. They're not obligated, or it's not secured. This is not insured money. 90% is uninsured. But anyways, so step 1 is trying to find a private buyer. Step 2 is on Monday they give you $250,000 immediately, and for the difference they give you something called as a receiver claim notification. So to help you understand this with an example, you are a company with $5 million in the bank. On Monday you're going to get $250,000 access because your $5 million is actually frozen. Now on Monday you get $250,000. For the remaining $4.75 million, they're going to give you like a claim notification. Think of it as like a check from the bank saying that you are owed this much. That's it. Now the bank is going to try to sell the assets. FDIC is going to try to sell the assets to the bank over the next many months and try to recover as much as possible so that they can fulfill the receiver claim notification, so they can give you back part or some of that 4.75 million. Now that's obviously not ideal for a business because we cannot wait for like 6 to 8 months. So what the bank does is they give you something called as an advance dividend. So they come up with a number, lump sum amount. This is usually done like 3 days after giving you the 250K. So usually like the next week on a Wednesday or a Thursday, they come up with a number. The last time a bank was shut down was in 2008, and the number that they came up was like 50%. So if your deposit was like, the remaining deposit like was 4.75, they give you 50% of it as an advance dividend. And if they're able to recover more than 50% in the next 6 to 8 months, they will come and give you more. But the 50% is something that you have access to immediately, right? In the case of SVB, they just decided to make all the depositors whole, so that's like a safe thing, crisis averted. But in many cases, it could be a percentage like 50%, as it happened in 2008. So that was an interesting learning for me. Last learning, which is something for all of you to keep in mind, and I thought I'll just put a Slack screenshot of what we are doing, and you can probably do the same for your company, and you can probably do the same for your personal accounts. So first and foremost, we have decided, we already bank with Bank of America. Luckily, we had no exposure to SVB. So what we've decided is that we're going to diversify our assets in these top 3 banks across BOA, Wells Fargo, and JP Morgan. Why did we choose these banks? Because if these banks go down, it's very unlikely, but more importantly, if these banks go down, it will, like something like a Wells Fargo has 45% of all deposits, consumer deposits in the US. So those people are too big to fail. And a government would not let banks like these fail. So your most safest option is to ditch the interest rates and put your money safely parked in these banks. Now, if you're an entity, you will still have only 250K insured as a whole. But if you're a person, an individual, then you get 250K insured per bank. So if your assets are in like 4 banks, 250K into 4, then $1 million is insured amongst the total 4 banks. Plus, it's very unlikely that all 4 are going down at the same time. So your best bet is to diversify. That's one. The second thing, as what we are doing is we are, because our sister concerned company, we have a parent entity which is headquartered in the US, and then we have a child entity which is in India. So we've decided to keep like 15% or maybe 20% parked in India at all times. and whichever is the main transacting bank, in our case it's BOA, will have maybe 60% of the deposits, and the secondary bank will have 40% of the deposits. So as the BOA will keep on depleting, we'll keep on funding it with the secondary bank, so that both of them have that 60-40 ratio maintained. So that's what we are doing as a business, and I hope that is useful for all of you guys and something for you guys to incorporate.